Good afternoon. This is Drew Erickson back again with another Money Not Math number 104. And today is about the two top takeaways on the stock market from the 2022 Morningstar Investment Conference. It is Tuesday, May 24th in the afternoon. It's a beautiful day here in Thief River Falls. Probably the nicest day we've had so far this year as far as weather goes. So I hope today's conversation brings you value. And as always, please don't hesitate to reach out and let me know what you think or ask questions and let me know what you'd like to hear in future conversations. So on with today's conversation, which again is the two top takeaways on the stock market from the 2022 Morningstar Investment Conference. And according to the Morningstar.com, the Morningstar Investment Conference delivers their signature research, insights, and analysis to professionals who want to empower investor success. The two main takeaways, the first was that despite all blaring headlines you may see, which are designed to scare readers into clicking on those articles, keep in mind, they try to control you through emotion, not logic. Nobody should be surprised by the downdraft in stocks and the rise in bond yields. Valuations had been high and there was a lot of froth in the markets. The big declines in both markets are painful but necessary reversals. BlackRock's Kate Moore summed it up well by noting a lot of the bubbles have been burst. So even though it hurts short-term and emotionally, we have to always keep in mind that supply and demand economics always will balance things out to where they should be. So what they're basically saying there is that for a long time, a lot of these companies, a lot of these sectors were being overvalued, and they were basically more money was being put towards them than what they were worth. And now those bubbles are bursting and we're kind of coming back down to earth to where things should be. But as we know, the pendulum always swings kind of too far before it balances out to where it should be. So we might be correcting now, but hopefully in the not too distant future, we'll be able to start going on the up and up again. But as we know, there's no way to know for sure, and we definitely should not try to guess the market. So that was echoed by Sarah Ketterer, Chief Executive of Causeway Capital Management. She told Wednesday's session that while stocks and bonds could still fall further, risk is actually lower than it was a year ago. So think about that for a second. Stocks and bonds are lower. If you look at your 401k today, it is probably worth significantly less than it was 6 months ago. And yet, Sarah Ketterer from Causeway Capital Management is saying that there's actually less risk in the market today than there was a year ago. And that all goes back to what I talked about previously of when things are overvalued or overinflated, they have to correct at some point, and that's actually a really risky proposition because who knows when that correction will happen. Are you going to buy at the high or are you going to buy at the low? So the other big takeaway was that there's a growing number of opportunities for long-term investors to take advantage of. We heard this from stock fund managers across the investment strategy spectrum. When fears of recession manifest in stock prices, it can create some attractive risk-reward opportunities, said David Guru from T. Rowe Price. And again, so basically what he's saying there is that when everyone else is freaking out because of what's going on emotionally, it actually creates opportunity for those who are following the fundamentals of investing, which is buy high and sell low. So again, remember the value in following fundamentals rather than emotions when it comes to long-term investing. And also remember that there's always a long-term approach. Okay, if you're putting your money in the S&P 500, it should be for a long-term goal, not for something you plan on spending it on in 6 months, right? So we have to be very clear on what is the strategy, but also two, what is the fundamentals we're using to achieve our goals, not the kind of emotional outcome of the short-term effects of the market, as well as what's going on in the news. Because again, going back to the first thing that was said, the news is the news and these articles, they try to use negativity and scare tactics designed to scare readers into clicking on their articles. They aren't trying to make your day any better. They're just trying to get clicks so they can sell ads. So again, remember, fundamentals equals buy low, sell high. Buy low, sell high. Emotions equals buy high and sell low until you are broke and there is nowhere to go. All right, so again, I've used this example 100 times. If you ever talk to me about investing, and I want to use it again. We're seeing gas prices skyrocket right now. With gas prices skyrocketing, are you excited to go out and buy more gas? Or are you maybe reevaluating what long trips you want to go on this summer? Most of us aren't really excited to go fill the gas tank. When gas prices are really low, it's like, whatever, I'll go buy a Suburban and we'll go on a cross-country trip because, well, gas prices are low. It makes sense when it comes to gas, but for some reason, when it comes to the market and investing in stocks, we see a stock skyrocket, and all of a sudden people want to get in. Well, the growth already happened, so now you're buying at a high, you're not buying at a low. Or we see a stock come way down. I'm hearing this so much in other people's chatter right now, whether it's your 5 months from retirement, 5 years from retirement, or 15 years from retirement. You see the market it's correcting, not crashing. And we're like, oh my gosh, we got to sell. We got to get into lower risk. We got to make all these changes. But guess what? The decline has already happened. So now if you sell and you reevaluate all your long-term plans, you're guaranteeing that loss and you're reacting emotionally, not fundamentally. So again, every situation is different. Every investment strategy is different. Everyone's investment goals are different. But just remember the two main takeaways from this article: and always invest utilizing the fundamentals, not the emotions around your stock prices and your stock reactions. So again, this is Money Not Math number 104, talking about the two top takeaways on the stock market from the 2022 Morningstar Investment Conference. Please comment on this post or message me directly with any comments or thoughts that you have, as well as questions and or requests for future Money Not Math conversations. Thank you so much for your time and hope you have a great day. Bye.